Hello and welcome to BloombergQuint. We're seeing, of course, more and more projections come in on the global economy and on individual emerging economies. The world is set for a recession in 2021, as are many developed and developing economies. Now, in developed economies, we've seen a large response come in both in terms of government spending and central bank support. In emerging economies, that dynamic is a little bit more complicated by fear of pressure on currencies and of rating downgrades. Joining us to talk about some of that is Jim O'Neill, chair of the Chatham House. Jim, pleasure to have you here on BloombergQuint. Thanks for your time.
Nice to be here.
Jim, let me start with the big picture and then I'll bring it down to EMs. Your thoughts on how the evolving situation in the global economy is looking. It looks like in most countries, we're off the absolute bottom in terms of data points, but it's very unclear how quickly we will rebound to pre-COVID levels. What are your thoughts as you're watching the evolving data?
So I have contradictory views. It's very clear that we're off the bottom. And I think in the coming weeks, it might feel at times when you look at reported data for June and July, that much of Europe and the Americas are having some kind of boom because of the speed in which the rate of change of activity will be presented. And so in that sense, and I've thought this for the whole time since March, it will feel like we're having a V-shaped recovery. And that's partly why equity markets are doing so well. However, it's still not clear to me that unless we have a vaccine, or until we get a vaccine, the speed will, as strong as it will be by normal times, it won't be as strong as the decline. So going to your core question, we won't get back to the level of pre-COVID activity that quickly. But it might feel as though we are moving very quickly in that direction.
Supported, of course, by large government spending and central bank support, which is reflecting more in the asset markets more than perhaps in the real economy. But that is very much a part of this rebound that we will see.
I think there's two or three things going on. First of all, is of course there has been an incredibly expansive monetary and fiscal framework in many parts of the Western developed world, much bigger than we saw in 2008. I was just reading something yesterday about Japan. The Japanese government have come up with a ginormous fiscal package, as has the United States, and Europe's looking modest by the standards of those two, but huge by the standards of Europe. And so that's the first thing. Secondly, this comes on top of the fact that the degree of severity of the economic weakness is actually a man-made decision as such, in that our governments closed down our economies. So if you lift the restrictions, that in itself will be like an additional economic stimulus. And then thirdly, of course, we have the great ingenuity and creativity going on in the private sector with, not surprisingly, perhaps as evidenced by the health sector and the pharmaceutical sector, showing degrees of imagination and cooperation that people, myself, certainly wouldn't have thought was possible before. So these three things together are pretty powerful positive economic forces.
Okay. Jim, if I turn the lens around to the emerging economies, you were talking about the large-scale response in the US, in Europe, in Japan. Now, in the emerging economies, again, we may be off the absolute bottoms in terms of data, but two of those factors that you talked about, support from the government and central banks, is far more modest, is it not? That complicates the recovery scenario?
I think No and yes. I think for large parts of the so-called emerging world, because of the collapse in commodity prices and the collapse in world trade, that is a big part of their problem. And so getting the developed world back to normal or towards normality and having their trade pick up in itself will be hugely beneficial for many parts of the emerging world, particularly those that trade in commodities. However, and here you're right, because of the peculiarities of the international monetary system, many so-called emerging economies don't simply have the wherewithal or the institutional credibility to take the kind of financial risks that so many developed countries have done. If a emerging country were to try and embark on the fiscal expansion that Japan has done, the financial markets might really panic about that country. And of course, that is the reality of the peculiar state of the international financial system, which is a limitation for many of those countries. It's true.
So you don't think, for instance, in the current scenario, there could be a case made, if I just use India as an example, but India is not alone, that at a time like this, perhaps governments would need to go back to a period when there was direct central bank financing, but put in place a medium-term framework to bring down their fiscal deficits to ensure that this is a one-off. You think markets would not be able to absorb that, even in that kind of a, let's do this in the short term, but we're telling you in the medium term, we're going to get back to a path of fiscal rectitude. That wouldn't wash?
I think it could. I think I love your line of pursuit and your questions. I think India is a particularly interesting example, but I think it's true for others. And the dilemma is, of course, so many countries, unfortunately in the emerging world, are so badly run. And we have a lot of governments in some parts of the emerging world where they will just use this as an excuse to do bad things. And that's why markets worry about them. But in some countries, or in all countries, but in any of these places, if the governments were thoughtful and they really tried to use this opportunity to be a lot more ambitious than a normal pre-COVID world would have typically allowed anybody to be, including the likes of Japan and the United States. And let's take India as an example. If the Modi government, and I would go out of my way to publicly try and embrace such an initiative if they did, so I'm glad you're asking me. But if they tried to seriously deal with this huge educational challenges in India and the huge systematic health weaknesses of India, and with the fiscal costs of that being the reason why the central bank would end up having to do some more ambitious monetization as such, I think that would be an incredibly smart thing to do. And I suspect the markets around the world would be forgiving, because these are the kind of things that are necessary in order for India to really reach its long-term economic growth potential. And in the spirit of never letting a crisis go to waste, why not?
The preconditions to embarking on any such program would be, to your mind, what, a medium-term framework, perhaps on the fiscal side? There's been a large call for an independent fiscal council in India. Those kind of measures you think would make it more palatable to markets? And what about rating agencies? There's a huge debate in India. We've already seen one downgrade as to whether rating agencies should be more forgiving in circumstances like this.
You know, from my experience, as much as one should respect rating agencies, one shouldn't let what a rating agency is going to do to get in the way. I mean, quite often rating agencies are reactive or lagging indicators. I've never thought of them as being particularly leading indicators. And countries should do the right thing. And I think you've touched on the key. Some kind of version of what the Blair government tried in the UK in the early 90s, where it had a medium-term fiscal policy framework where it would try to distinguish between what was government spending on consumption as opposed to government spending on investments. And particularly if India is considering having some kind of independent fiscal council, is exactly the way to do this. And I think the rating agencies would probably be pretty forgiving too if they saw that there was a major rise in Indian public spending, but it was exclusively towards health and education. I cannot imagine why a sensible rating agency would want to downgrade India. If anything, it would be in my opinion, if I were running a rating agency, it would be a criteria for upgrading India.
Jim, a slightly more medium-term question from the perspective of central bank priorities. Now, again, in emerging markets, as a follow-through to what happened in the developed world, more and more central banks went to a single target focused on inflation. I happened to hear an earlier interview of you where you were talking about, shift in mood towards perhaps nominal GDP targeting in the developed world. I was curious to know whether you think that the mood in the emerging markets could also change away from sort of single-focused inflation targeting?
So I think this is tricky due to the nature of the international financial system and institutional memory, because a number of countries that have had single policy, in particular inflation targeting, have failed quite often to meet those inflation targets. So countries that would be like those that suddenly announced nominal GDP targeting, I suspect the markets might not be very forgiving of those. But others that have generally been successful in reaching the inflation targets, why not? Because we live in an era, by and large, around the world, where the biggest fear is one of deflation rather than inflation. And even for those countries that have thought very much about the dilemmas of inflation targeting, I believe that inflation, single policy-driven central bank focus of just on inflation targeting has sort of lost its way. I thought that before this crisis, and with this crisis, it becomes very clear to me that what we have to do is going right back to your first question, is not try and increase the probability of a V-shaped recovery, but to try and increase the probability that the GDP lost around the world through this pandemic can be at least made up for as soon as possible. And one way of doing that is to adopt nominal GDP targeting. So by and large, I also think it is something governments should consider giving their central banks in emerging countries as well as in the developed world. But with the caveats that for those countries that have not succeeded in achieving the inflation targets they set out, they'd want to be careful.
So perhaps a little early for India. We've only completed one cycle of our inflation targeting regime. If we give it up this soon, may send out the wrong message, perhaps.
I think it would. It could be quite easily misinterpreted in India's case. But I do think adjusting the framework for accounting for a much more thoughtful, albeit ambitious fiscal policy framework would be a very sensible thing for India to do.
Okay. Jim, a couple of questions specific to India, but not specific to the crisis. When Moody's downgraded, I'm just using their analysis, not so much their downgrade. They downgraded India, and they pointed out very clearly that was the deterioration in India's growth over the last few years, starting 16, 17. That is a point of concern to them. That we haven't actually moved towards what was considered potential. Does India's growth performance disappoint you?
It's been very disappointing in the last few years. And of course, it starts to make one wonder whether many of us overestimated India's growth potential in the first place. And it's hard to tell because there has been a combination of global shocks, as well as domestic Indian policy disappointments. But I think it sort of goes back to the nature and the specificity of policy. The Modi government has often talked a very good game about structural policy reform, but when it's come to it, it's often shied away from it. If I go all the way back to a piece I published in my days as chief economist of Goldman, along with a colleague of mine in Mumbai at the time, on 10 things for India to do to achieve its potential, India has not got close to delivering on hardly any of those things. And its education, its health provision, its specific things to do with trade policy, its opening up in terms of investment policy. And India has simply not done any of those things. And until it does, it's going to be difficult for India to get to the double digits rates of economic growth that in theory, its remarkable demographics give it the opportunity to achieve.
That demographic, Jim, is increasingly, I don't want to use the word burden, but it's increasingly looking at like a drag, right? From everything we know, although we don't have real jobs data, it doesn't look like the economy is producing enough jobs to get that demographic into the consumer space and then investment, etc. Is that a big problem? Is that one of the bigger problems that needs to be tackled?
I think it is a huge problem, and this underlies the whole long-term debate about India. This is something that should attract the attention more of global policymakers as we move to a situation where China's demographics have started to turn, and a world in which China has primarily been responsible for lifting the growth performance of the world economy in the last 20 years. And as China demographics turn and China can't grow so much, there is only one other country in the world that has a sufficiently large population and a sufficiently large economic base in order to have the slightest chance of replacing that, and it's India. And so if India could turn the demographic advantage into a true dividend, it would be incredibly important for the world. History, for countries with very explosive population dynamics, if they can't raise their growth potential, this ends up becoming a major burden. And it's an issue, and has been an issue sadly for decades for Africa. And in India's case, since the early 90s, it looked like India was starting to get on a much stronger positive path. But somehow the past 5 or 6 years, India seems to have lost its way a little for a number of reasons, some of which are external. But one of the great things of having such a large population, particularly given at a time of such challenges about international trade, India does have the potential to determine all of this itself. And one of the ironies of not being as strong international trade participants as it could be, which is the case with India, that means that its economy is greatly driven by domestic forces. And so if India could do more to turn that demographic advantage into true productivity benefit, the potential for India would just be spectacularly exciting.
All right. Jim, a last couple of questions sort of linked to some of what you were saying, the external market versus the internal market. What are your thoughts on this mood against globalization? Back in India, we have, a policy objective, of self-reliance, although there's a lot of fear whether that's self-reliance or protectionism. But globally, how do you see the sort of trade cycle turn as a consequence of what has happened?
It's a more complicated than the general image out there, in my view. At the end of the day, the core thing that drives globalization is what all 7.5 to 8 billion consumers do, what you and I do, and everybody else. And as we get more informed and as our aspirations grow, if we want to try and acquire the material possessions and the wherewithal that we choose, irrelevant of where they're from, that is in essence what drives globalization. And we go through different waves of the speed and nature, but this idea that globalization is sort of permanently finished, I think is exceptionally naive. In fact, if you look during this crisis, and I touched on a part of it at the beginning, that if you look what's going on in the pharmaceutical industry and the incredible international cooperation that's going on in the private sector, it's extraordinary. If you look at what's going on in terms of modern technologies, look what you and I are doing in this discussion here over Zoom. You know, a year ago, I had no idea what Zoom was, and I never dreamt I'd be essentially carrying on a large part of my life as normal as ever with something like this. And, you know, again, one of the reasons why the stock markets might not be as crazy as a lot of people often think, me included, is that the equity market recovery has been dominated by these two sectors. And they are living proof of globalization being far from dead. What is likely to have changed, and this raises an opportunity for India, is that the scale of the reliance on China as the single dominant force in the supply chain around the world has clearly come to an end. In fact, it had come to an end even before this crisis because of China's own cost base. That shouldn't be misinterpreted at all, in my view, for globalization having come to an end. And once the world economy recovers sufficiently from this crisis, I think one of the surprises to the consensus, it won't be a surprise to me, is just how quickly global trade recovers.
Interesting. Jim, as I close off this interview, do you want to bring out any red flags that you would watch out for, that policymakers need to watch out for to ensure that what seems like the beginnings of a recovery doesn't get pulled back? Is it actually all health, which is more important than anything else? This is not the GFC. There's very little we can do about some of what's playing out.
I think the number one thing is the health discovery path. I joked with some friends of mine last week that I wish I would have been a day trader or a week-to-week trader of stock markets, because it's been very clear since February that the markets essentially are trading the rate of change of the infection curve and the drug discovery curve. And if we get to the autumn, or in terms of European time zone, if we get to September time, and we have got no further progress about vaccine developments, then I think things are going to get a bit trickier. But against that, if we do get to September, and some of the hopes about particularly the vaccine coming out of Oxford University here in the UK turn out to be true, then that will be spectacular developments, which could indeed then mean there's a genuine degree of hope that sometime in 2021, the level of GDP around the world will get back to where it was before this crisis started. The only other potential real red flag, which I haven't talked on a bit much, is of course, in contrast to the GFC, where there was incredible, at least for a year or so, international cooperation between governments, we are not getting that this time. And the sort of the retreat to playing domestic politics and trying to suggest that cooperating with others is some kind of detrimental thing is something that does bother me, because that smacks of the 1920s. But hopefully, so long as the private sector leads the way, particularly in the health space, then that won't be as important as otherwise it could be.
All right, watching out for that. Jim, it's been an absolute pleasure. Thank you so much indeed for your time and your thoughts here on BloombergQuint. Thanks so much.
Thank you for having me on.